So this is the part of the show where I discuss what I believe is important for individual investors to consider over the next few weeks before you make your investment decisions. And you'll notice there that the first two topics have been on my list for quite some time. In and out, not every week or every show, I should say, but in and out. The first one, Fed speak, that is always on the list. Every time you have a Federal Reserve governor, this morning we had Loretta Mester talk about how interest rates need to get above 5% once again. And therefore, that tells all of us that she believes interest rates got to go up again in the US. So whenever a Fed official speaks about higher rates, it affects the market. If they were to say, we're going to pause, that would probably affect the market in a positive way. So Fed speak's always important. Bond yields. We've talked about bond yields in the past. I really believe interest rates, bond yields tell the whole story as to where the market has been and where it's going. And lastly, dividends and trends. This is something new. If you feel the market is going to have a slower year or the economy is going to continue to slow and struggle throughout 2023, look to dividend pairs. Look to things that are trending in the economy today for your investment ideas. And we'll go over that as well. So let's get to the first one, Fed speak. Now, as I said, as early as or as recent as this morning, the Federal Reserve was speaking about how, not one of the Fed officials, I should say, Loretta Mester, was speaking about how interest rates need to go up even further. And that actually kind of surprises me a little bit. I think with the most recent bank crisis, in my opinion, caused by aggressive higher rates or aggressive interest rate hiking cycle. And we have a chart to show exactly how quickly interest rates have gone up in the US. And you can see here, they've gone up 9 times in the last 12 months. The first rate increase was about 25 basis points, and then 50, and then 475 basis points hikes in a row. And then here we are at the tail end of the hiking cycle, hopefully, and we're still getting these 25 basis point hikes. So it surprises me that when a Fed official says we still have to raise rates even more to tame inflation, I'm surprised, because with the banking crisis, many people have said that that would be equivalent to a 50 basis point hike on its own. The fact that banks are now more cautious, they're not lending as much anymore. Credit is drying up out there for businesses to get a hold of, for individuals to get a hold of, to grow, to acquire, to buy goods. Demand is going to slow down. So you don't necessarily need to be raising rates to slow the demand. The banking crisis and the banks are going to do it for the Fed. And that's been the talk a lot recently. And so to hear that Fed officials are still touting and saying rates need to go higher to fight inflation, I'm quite surprised. If you look at all or many of the inflationary indicators, things that are indicating inflation, or if it's going up or down, you're seeing inflation going down in many areas. Retail spending, you're seeing even jobs growth is starting to slow from the big number we saw at the beginning of the year. You're seeing spending, income, everything that you would want to see if you're the Fed slowing down. Job openings, JOLTS as we call it. We just got that number recently. Job openings actually dropped over 1 million since the previous month. So we had over 10 million jobs available in the US. Now they have about 9 million jobs available in the US, down 1 million from the month prior. And that's a good thing for the Fed, because that means that the labor market is hopefully loosening up a little bit. So overall, very surprised to hear the Fed and the Fed governors talk like that, continue to speak about rising interest rates. But again, keep the Fed close by, understand what they're saying, because that's going to affect how you make your next or the next investment decision. Topic number 2, bond yields. Now, as I always say, interest rates, bond yields tell the whole story. So when everybody was talking about interest rates rising, bond yields have to go up even further. We saw the 2-year government bond rate in the US over 5%. Today, and we have a chart on this, the 2-year rate is below 4%, 3.85 to be exact. And we have a chart of the US 2-year Treasury rate. And you will see that it is well off its previous high. You can see on the far right of this chart how much the 2-year rate has come down. If we go to the next chart that we have, the 10-year government bond rate in the US, that was well over 4% at its peak. Today, it's sitting somewhere around 3.35%. And there it is there. So you can see how much bond yields have come down. And you would think that that's a good thing for the market, and it has been up until recently. Now the bond yields seem to be coming down because the market is telling us that, we may see really a much larger slowdown in the economy than was anticipated. And that's why these yields are falling. Back when the economy was doing quite well, things were growing, and if we saw bond yields not rise as quickly, that was a good thing. Now we're seeing bond yields coming down for negative reasons. So what I tell individual investors how you should look at bond yields is not too high, not too low, kind of just right. Goldilocks, as I like to say, the Goldilocks scenario. So we don't want to see necessarily bond yields fall anymore. That's a negative for markets because it puts fear into investors, because that tells us maybe a recession is coming down the pipeline. But we don't want to see interest rates too high, because then that will compete against the stock market. And we know that things such as tech stocks or other investments don't do well, especially in the most recent rising interest rate environment. So we want to see bond yields kind of level off and stay consistent. Don't gyrate as much as they have. And as you saw in those charts, interest rates have been moving almost as much as the stock market has. And that's not something we want to see. So keep an eye on bond yields. The last topic that I think individual investors need to focus on before you make your investment decisions is this idea of what do we do and how can we make money if the economy is slowing down? And I put on that list, if you recall, look to dividend payers. That's number one. If you can't make money, if the stocks are not going higher, if you're noticing that at best you're just kind of going sideways and treading water, what should you own? Well, I have a few really good dividend paying stocks. First one, Enbridge. All of us pay our Enbridge bill here in Ontario, Toronto, and as long as we're paying that Enbridge bill every month, Enbridge has money coming in. Enbridge is a fantastic company. Stock usually ranges between $50 and $60. Seems to be their range right now in the low 50s, but it's paying almost a 7% dividend. So for all you investors out there that want to make or need to make an income, Enbridge is a fantastic name. They continue to raise that dividend over time. Right now, as I said, paying just under 7%, but it's a name I think you can count on for future dividend increases, or at the very least, maintain the dividend that it pays. Another chart I have of another company called Pioneer Natural Resources. I wanted to give you a variation of companies that are out there. Now, Pioneer actually pays a dividend of almost 13%. It is a U.S. oil and gas investment. And as you can see, stock has gone up recently from its lows. It was as low as below 200 at one point recently, now back above $200 a share. But a lot of people, a lot of investors are buying this for the dividend. So if you're not going to grow or see an appreciation of share value, making a 12, 13% dividend is pretty darn good while you wait for future growth. Next chart I have as another good dividend player, something closer to home. Again, Bank of Nova Scotia. I've talked about Bank of Nova Scotia on this show many times, and Bank of Nova Scotia is paying about a 6.25% dividend. Bank of Nova Scotia trades at around $67 a share, down from the mid-90s. So this is one of those investments that I think you can get great dividends and also capital appreciation. So I think the stock is going to rise at some point in the near future once we get through a lot of the crises that we're going through right now in the banking sector, even though it's U.S. banking sector that has the crisis, but a lot of this is spilling over into Canadian banks as well. Once we get past this, I think a name like Bank of Nova Scotia will definitely move higher. So those are dividend ideas that you could use if you're about to invest in the market. The second thing I had on my list is trends. How you make money in a market that's going sideways? Well, as we know, not everything goes sideways with the market. Things will move higher in a sideways moving market, and those things are usually the trendier investments. What is trending now? Well, one thing that comes to mind is artificial intelligence. So stocks that have anything to do with AI have been moving higher. Microsoft, some of the chip makers, some of the companies that make the chips for artificial intelligence, like NVIDIA, AMD, even Amazon has moved back above $100 a share again. Google, or Alphabet, I should say, back above 100, and Meta, or formerly known Facebook, has been moving significantly higher. They've been talking a lot about artificial intelligence and moving away a little bit from the metaverse and focusing more on AI. So what investments should you be focusing on or considering before you decide what to do with your money over the next few weeks? Look to dividend pairs and look for what companies are in those hot areas that the market is favoring right now. And I think that's what you should be doing before you make your investment decisions.